sentiment is because over half of consumers that don't don't have any wiggle room, the 54% of households that are just getting by, if that, the sentiment is poor, right? Because they're seeing the economy do really well, the stock market do really well, but they're not participating with that. You're seeing everybody go to a party that you're not invited to, and that, I think, it's the have and have-nots. That's so tough.
Meredith Whitney, CEO of Meredith Whitney Advisory Group. It is such a pleasure to welcome you to the show. Thank you so much for taking the time to join me today, Meredith.
Oh, great to be with you, Julia.
Well, I'm really excited to have you on. And Meredith, I'd love to start this conversation where I always start with my guests, and that is to get their, big picture, macro view. And so I want to give it back to you. And one of the things about this show, Meredith, is you can take all the time you need to set the table when it comes to that macro picture, that framework in which you are looking at the world today.
Yeah, so my specialty is the U.S. consumer. And because I look at consumer data so closely, and it's so granular, I have a very unique and specific view and convicted view of how I see the economy. And so last year, just to set the table, last year, I did not think we were going into a recession, largely because the consumer was in a really good position. And the consumers obviously contributes to over 2/3 of the U.S. GDP. And so then when you look at the consumer, you can see the strengths and the weaknesses. So last year, the consumer at large was very strong. This year, I would use one word to describe the U.S. economy, which is bifurcated, and it's a bifurcated consumer. So 2/3 of the economy is controlled by consumer spending. 2/3 or over 2/3 of consumer spending is controlled by or driven by households that earn over $70,000 a year. And that's an important distinction because it's 46% of households earn over $70,000 a year. The mean income for a household is over $90,000. But the way the census divides things, it's 50 to 70, 70 to 90, and so forth. But the 70,000 is a key threshold because those who earn over 70,000 are spending slightly less than what they're earning. Those who are earning less than 70,000 literally have no wiggle room. So the cohort between the households between 50,000 and 70,000 are spending 99.7% of their after-tax earnings. So when inflation persists the way it has, it really hurts. There is literally no wiggle room. So I think that you're seeing, and what I wrote about in terms of my preview for 2024 is you'd see the low end really strained. And so how it manifests to stocks, the subprime financial players would be strained with higher delinquency, higher charge-offs, and that's what has happened. And you saw that in the fourth quarter results. And then the high-end companies like American Express would do very well because they have higher earning customers. So what you've seen is real stress in the dollar store customers, in Synchrony Financial, in Capital One, in the buy now, pay laters. SoFi has a very high concentration of subprime customers, even though they say they don't. They do, and so you're going to see, I think, significant delinquency and charge-off problems within their portfolio, and in fact, they're pulling back on that portfolio that has grown like gangbusters. So it's a tale of two. It's really a tale of two stories within the U.S. Going further back, like because the high end is so strong, you will not go into a recession this year. The other unfortunate thing is the government has no interest in guarding in terms of safeguarding spending. So you've got government spending that's untethered. So that combined with the high end consumer should keep the economy doing fine.
Yeah. So because of the high-end consumer, we won't see a recession. But it is interesting, the bifurcated part. I want to explore that more. And that, does that have to do with the inflation that's really taking a bite there? And it also makes me wonder about like the sentiment that folks might have about the economy. It seems like there have been a lot of headlines about the resilience of the economy. I also wonder, like, what about the sentiment?
Well, I think the sentiment is because over half of consumers that don't don't have any wiggle room, the 54% of households that are just getting by, if that, the sentiment is poor, right? Because they're seeing the economy do really well, the stock market do really well, but they're not participating with that, and they have to. They're adapting, but they have to get by with what they have. It's like you're seeing everybody go to a party that you're not invited to, and that, I think, it's the have and have-nots that's so tough.
Yeah. How about when you look at that the bifurcation? Do you see anything amongst like demographics, maybe more generations? Because I'm thinking like, okay, I'm a millennial that would love to buy a house, but I kind of feel like I did all the right things, and there's not much supply. The prices are extremely high, so I don't know. Like, do you have a take on? I mean, I feel like a lot of my friends are in a similar position too. It's just kind of like I thought that we'd be buying by now, but do you see anything within generations?
Sure. Well, I focus a lot on housing, right? It's the largest asset within household net worth, and equity is the largest asset within the home equity is the largest asset specifically within household net worth. And 90% of U.S. homes are owned by people over 40. 74% of U.S. homes are owned by people over 50. And 56% of U.S. homes are owned by people over 60. So there is absolutely a generational issue. And so I don't look at generations, the younger generations, the way most people do. I look at, importantly, a generation. I combine half of the millennials, the younger half of the millennials, and Gen Z. So I call that the avocado toast generation. So it's 38 and under. And that's less than 10% of the housing owners, right, in the U.S. And homeownership the average first-time home buyer has gone from the low 30s up to the high 30s in the span of a decade. So people have to wait longer to buy homes. And the problem is that typically you'd see when rates go up, asset values go down. So home prices will go down. And that hasn't happened. I think that will happen. And I expect home prices to go down meaningfully over an extended period of time. And here's why. Because you have so much housing stock owned by older people, they will downsize. So AARP estimates that 50% of people over 50, 51% of people over 50 to be specific, downsize. And it gets lower as you get older, but they downsize because of affordability and because of livability, in terms of they want to have a primary room on the first floor. They want to be able to age in place. And what that means then is, if you equate that to numbers, that's 45 million homes that will come on the market. So last year you had under 5 million existing homes sold. And I think the peak was in 2005, when you had 7 million existing homes sold. So if you think of that number, and even if it's a portion of that number, it's still a pig through a python. So you've got a supply glut that is inevitably going to hit the market. And that will mean home prices come down. Now, importantly, it's not like a 2007, 2008 phenomenon, because there's so much equity. This time there's so much equity in homes. So there's no forced selling. There's no foreclosures and forced selling by banks. But there will be a orderly process the whole time, which home prices will come down, just because of the math, supply demand. And that will create more affordable availability for younger people. But you'll have bigger home price declines in certain areas versus other areas. But you're in a good position because home prices are coming your way.
Okay, so maybe it's okay. It is okay to be patient, it sounds like.
it's gonna pay off to be patient.
And what kind of timeline are we thinking about here?
Well, spring season started early this year, and you have more houses on the market. So the time period is, I think you're going to start to see, evidence of it near term, but this is a long-term trend. So this is a 15-year trend, longer. There's just that much, like, it'll take a long time for that much supply to go through, to go through the market. And I think also some different things are going to happen with housing, as well. You know, it's interesting. It's interesting and terribly sad that you have the lowest household formation rate on record. And that's because you have the highest percentage of single men on record. And so people just aren't, you're going to have a supply issue, and then you're going to have a demand issue. And I think that there's going to be a lot of change within the housing market.
Wow, I didn't even think about that, the supply issue as well as the demand issue, because of the singles, mostly probably in my generation.
Yeah, and I think that, you know, what people focus on is recency, and what I do is I take a giant step back and look at and look at trends and look at. I mean, I always am data driven, so I look at trends, and this isn't. I mean, this is the math is undeniable. This is basic econ 101.
Hey there, I hope that you are enjoying this interview. If you can, please take a moment to hit the like button, subscribe to the channel, and ring the notification bell. This will keep you up to date with all of our new interviews, and it will also help us grow this channel and continue to bring some amazing guests. Thank you so much for your support, and enjoy the rest of the interview. You know, one of the things that's fascinating about you and your analysis, you're an incredible storyteller, and I don't know if that goes back to like your roots as like a history major or whatnot. You've always been great at connecting all of the dots and putting together the story. So like, what is the story for you today that's maybe not getting as much attention, or like that narrative that's especially compelling to you today?
Well, thank you very much. I have to beat the data down to levels where I can understand it. And you know, very fortunately, I was sort of raised in the industry that if I couldn't explain it in a way that, if I couldn't explain things or analysis in a way that everybody could understand, I wasn't doing my job. So it's important to bring everybody into the story so that everybody can understand, because people are smart about very different things. So they may not know about finance, but they'll know about medicine, or they may not know about finance, but they'll know the art world incredibly well. It's just everybody's focused on, or they'll know engineering, or they'll know so I just assume, and also if things are very interesting to me, I get really excited about it. So there's so much that's interesting to me now, and demographics, and again, the consumer driving all of this, demographics is so interesting to me now. So I'm focusing a lot on aging Americans, what's called the silver tsunami of a generation, the baby boom generation, which by 2030, you'll have more people over 65 than under 18. So 11,500 people a day turn 65. And what that does to not just housing, what it does to the overall economy, what it does to the labor force, and what it does to government entitlements, which is I think underappreciated, is really important. So I'll give you an example. 70%. So as I said, 56% of U.S. homes, single family homes, are owned by people over 60, and it's estimated that over 70% of people over 65 are going to need long-term care. Only 1 in 10 can afford it. So what happens? And this is going to be a massive, massive issue for the next 20, 30 years, because it's a real crisis. And so you have a situation where you have 15% of seniors are, 15% of seniors qualify for Medicaid and Medicare, right? So if you have below a certain number, level of assets and below a certain level of income, you can qualify for Medicare and Medicaid. That allows you to get into nursing homes, right? If you have assets and income above that threshold, the only alternative you have is at-home care, which is a health aid, or assisted living. As I said, 1 in 10 can afford those, right? And you have a 21% rental rate within seniors. So 79% of seniors own their home, 21% rent. Only 15%. That's going to converge. That's not in CBO, Congressional Budget Office numbers in estimates. So I think entitlements are going to be far more than the government expects in the form of Medicaid. And I think from a health crisis standpoint, you're going to have 75 million people who need 75 million is the total over 65 by 2030. And there's going to be some type of reckoning in terms of, again, as it goes to housing, as it goes to care. And then I come up with things that I think will be creative solutions, which are, if people can't afford assisted living, can they afford group housing? I don't know if you're too young to remember the Golden Girls, but it was a sitcom in the 80s where 4 seniors lived together in a house in Miami, and they shared expenses and laughs and stories and good times. And I think you're going to have to have creative solutions like that, where you can have group housing where they can share a health aid, where they can share common household costs. Like, to be I've always tried to marry a problem with a solution, because that's constructive as opposed to just being a doom and gloom sayer. So unfortunately, I'm focusing on a lot of negative things these days. It's just, I'm usually a bright and cheery person, and last year I had only good things to talk about. This year it's different.
Yeah, it's fascinating though to think about, and I appreciate you even highlighting these challenges. Let me ask you this though: when I think about our fiscal situation, I know you wrote a book called The Fate of States, looking at the fiscal situation of states a decade ago, but even just looking, we can throw that in there, but even looking nationally, with our debt is now above 34 trillion and ticking higher. How do you kind of think about our fiscal position, maybe as a country, but you can even get even more granular states and on a local level as well?
I'll take both. So all the work that I did in the States, what's now 13, 14 years ago, and then I published a book in 2013, was based on the idea, how would the U.S. recover from the great financial crisis? And historically, economic shifts occurred every 60 years. So you look at the Industrial Revolution, the Power Revolution, the Manufacturing Revolution. I may be skipping one. Then what was sort of the Sun Belt Revolution of leverage in terms of all of the home building across the Sand States, and then now what would happen? And all of those economic revolutions were regionally driven, right? So the Northeast, the Pennsylvania, Texas area, and then manufacturing Midwest, and then the Sun Belt. And what I saw very clearly was the next revolution would be state specific. And that's exactly what's happened. So you've seen state arbitrage drive demographic trends to tax-friendly states and business-friendly states. Today, Texas has more Fortune 500 companies than any other state. So what happens is jobs are created, or it's not really chicken egg. It works simultaneously, but people go where their jobs. Then the companies demand better infrastructure, better education, and that begets more people going there. And so what you're seeing is huge demographic moves from states that have population trends. New York, Chicago, Pennsylvania, Ohio, Connecticut, into states like Texas, Georgia, Tennessee, Florida, but also Utah has been huge, and Nevada. So you see big booms there. And that's sort of self fulfilling. New York has twice the size of the budget of Florida with just as many people. And so I think you're going to see real compromises to social services. Those are the things that are not constitutionally guaranteed. And that's what drives the rich people away, and then what really harms the people with less money. Now, from a national standpoint, what's very clear is the fact that we're so dependent upon foreign buyers for our spending is, I think, a national security threat. And there seems either candidate seems absolutely uncommitted to having a balanced budget. So the last time we had a balanced budget was 2000, and we're so far away from it. It's politically unpopular, and it's very short-termism to spend now and worry about it later. But to me, it's one of the most important issues out there.
Flesh that out a bit, a national security threat. I think people need to understand the importance of this.
Well, the fact that we're so reliant upon foreign buyers to buy our debt, and foreign buyers have basically stopped buying at the rate they were. So Japan, China, everybody's going back into a nationalist mode where they're focused on their own economy, their own debt. And the Fed can only buy so much of our own paper, and the banks and the financial system are the biggest buyers of our debt now. And at a certain point, when you're issuing more and more, you need more buyers, and there are fewer buyers. And so that becomes then a risk, because the fewer buyers, it's a supply demand issue. Rates go higher. I don't see how rates go meaningfully lower, regardless of what the Fed does, just because the supply is growing at an untethered pace, and the demand is only so much.
Meaning, even if they cut interest rates, we might not. Can you help me understand that just a bit more?
I think that so you have short-term rates driven by the Fed, but long-term rates are driven by the market. And what's happened is the Treasury is issuing a lot of short-term paper, but the longer-term paper, when they issue that'll be market-driven, and fewer buyers will demand higher rates. That's how I see it.
Got it. That makes sense.
And of course, then we're beholden. Let's say you see foreign owners start to sell. That drives rates even higher, right? So this is why I say it's a national security issue, right? Because we're at the behest of other people. Whereas you could go back to 2000 of a balanced budget, we're at the behest of nobody.
Do you think? Okay, so what I like about your analysis is you do offer solutions. Do you think it is possible? Do you think we'll ever see a balanced budget? Do you think is that something that's possible?
I think I don't know. I mean, I'm so Pollyannish about things that of course I want to see it, but I don't see it in the near term. I mean, we've got to grow our way out of the position we're in now, but it does politically. There are no champions for a balanced budget right now. So, just realistically, without a champion, it doesn't seem realistic.
Yeah. Before I let you go, I would love for folks to I think a lot of folks know who you are and the work you've done over the years, and especially your work as an analyst in and around the financial crisis. And I watched a great masterclass featuring you, and I mentioned that to you earlier. And I love the opening of the masterclass because it was March 12th, 2008, the morning, and you were about to publish a major research note that had serious implications. And I remember, I think the opening of it, you were scared to publish the note. Or can you take me back to that time and share more of that story, the research you were doing then? Because I kind of wonder, was it You were right in all your calls. They were very prescient. Why was there fear around the call at the time?
Okay, so that was a Bear Stearns note in March. I put a note out on October 31st, 2007 on Citigroup, and my process and my work has not changed throughout my career. I just keep getting better, but my process never changes, and the way I do research and publish research hasn't changed, doesn't change. What did change on November 1st was instead of my industry paying attention to things that I publish, the world was paying attention to what I published, because it was a siren call basically about the financial system, even though it was only about one bank, Citigroup. And it was about specifically Citigroup's balance sheet and income statement, whereby they couldn't afford to continue to pay the dividend, and they needed to raise capital, and they needed to sell assets. I mean, that was just simple. And I looked simply at the leverage ratios between Citi and every other bank, and then went back and explained how Citi got in this situation it was. But that was sort of, people had been waiting for something for a while, and I brought it to them unbeknownst to sort of me thinking that that's what I was doing. I was just doing my job. So that got a crazy amount of attention, and then a crazy amount of attention on me that I wasn't used to. And I think it was a week or 2 weeks later, I put a report out looking at how the regulatory capital of banks was tied to the rating agencies, and the rating agencies' ratings of mortgage-backed securities and CDOs that they looked at one time and then never came back. So there was a massive tidal wave of downgrades and then regulatory capital needed. And I very precisely talked about which banks would need to raise capital, because I just looked at what their assets were on the balance sheet. Again, more attention. And when I say more, I mean a ridiculous amount of attention. And for somebody who's not used to it, it's you don't know how to handle it. And so everything that I did every report that I wrote got so much attention and it was all negative, right? And it was, Citi had a solution. All of my stuff had solutions, but it was very negative. Like it would require banks to raise a lot of capital, and a massive amount of capital. So let's call it, at the end of the day, close to $500 billion in capital, which the banks raised. And some of the banks never recovered. I would argue that Citi has never recovered. So come to March with Bear Stearns. Bear Stearns was a high yield player with a lot. At any rate, so they had a blow up in this summer with two of their funds, and then it was very clear to me that they were going out of business very quickly, and it was. So I was in Europe at the time. I'd flown over on Monday, and on Wednesday, I remember calling a friend of mine, Ken Moll. I was scared to death because I didn't want to be like the grim reaper of like crushing banks, right? Because Citi lost. The market was down. I think I want to say 4% when I made the Citi call. It had that. I had that kind of impact on the market at the time. So I was very scared. Like, was I like, were the Feds going to come after me? Like, I was just, I know that sounds paranoid, but it was a crazy, crazy time. So at any rate, I was on the tarmac and I called my friend Ken Moles, and I said, could this even be possible that a major could just go down? And he said, the more leverage, the less margin for error. And so anyway, I sat on this report for a week, and finally, after I think it was the third or fourth time, Alan Schwartz, who was CEO at the time, got on television to defend it. I was like, it's over. So I issued a report that Friday that that Bear Stearns was going to go out of business. And I remember I had to call in to the trading desk to make the call. And everyone thought I was crazy. Like, how could this be possible? Where would you, what is the stock worth? And I said, I don't know, $2. I don't know. And that Sunday night before Asia opened, JP Morgan bought Bear Stearns for $2.
Wow. Wasn't it also I want to say, didn't you have some sort of interaction where another analyst was like, they weren't even modeling Citigroup or something?
So this was, you always think, you're always grateful for your cumulative experiences, although they may seem miserable at the time. But my friend Gary Crittenden, who was CFO of American Express, went to Citigroup. I remember the report when he left. I titled it "Who Leaves a Cadillac for a Kia." This is before I wrote the report on Citi. This was like, why would Gary go to Citi? At any rate, he did, and so Citi was having a cocktail party to meet and greet the new CFO. Now, Gary is Mormon. There was nothing cocktail party about Gary Crittenden, okay? He's amazing, but it quickly turned into basically an analyst meeting, and maybe with a couple people with cocktails and other with Cokes. And the analyst that I admired the most, and when I say that, the nerdiest analyst, who I thought was so data specific, said, "Oh my gosh, I've given up modeling Citi. It's just too complicated." And I thought to myself, that's your job. You can't give up on it. And what Citi had done was restate everything. So every quarter or a couple of quarters, they shifted around the segment reporting. So it was very difficult to watch, to create real trend lines. And so I went back to the office and I was like, okay, I'm going to do this. Of course, I had always modeled it, but I'm going to boil this down to the simplest story I can do. And that takes a lot of work, right? And so I had the Citi report ready a month before I published it. I didn't want to get in front of the Fed. And I just, I beat it into so that Citi report is a perfect report because I just streamlined everything. So anybody from any walk of life could understand what position Citi had gotten into. But I've got to thank the analyst who said it was too complicated, because if something's really complicated, then a bug gets in my head and I'm like, I got to figure this out.
I love that. I love that, distilling and telling the story. Meredith, I've really enjoyed listening to you and learning from you. I want to give you the final few minutes here to, let folks know more about the work that you're doing today and how they can support that work, and any parting thoughts that you'd like to leave with the audience. The floor is yours. Okay.
So, what I did this iteration was my research is the same. I love it. That it doesn't feel like work. It's awesome. I've got incredible stuff coming out. I'm so excited about. And so I have basically a retail rate that anybody can go to the website, meredithwhitneyllc.com, and subscribe for an annual subscription. And I'm really happy about the product. And I hope, and I priced it in ways that everybody could access it. So it's very user-friendly pricing. So I'm thrilled about that. In terms of anything else I want to talk about, I would talk for the next 5 hours or 10 hours about the stuff that I'm doing. It's just, I stepped away from the business for 10 years because I thought there wasn't really anything I wanted to write about. And now I have the opposite issue where there's so much stuff that I want to write about. And I think that there's a need for really good research and analysis out there. And I still can't believe that I'm doing things so differently than everybody else. Because what I do is I look at publicly available data, but the breadth of data that I look at, and then the way I put it together is so different. But because it's so data driven, I have high convictions, and they're usually, early and then right, which gives people time to position themselves and then make money from it. So I'm really proud of the stuff that I've put out for the past 25, 30 years, and it just keeps getting better.
Well, I love it. Meredith Whitney, CEO of Meredith Whitney Advisory Group. Thank you so much for being so generous with your time, your ideas, all of your knowledge. I really appreciate you taking the time, Meredith. Great having you.
Well, you're a great interview, and it was a pleasure to be with you.
Thank you so much.